Credit scores, one of the most important aspects of your financial well-being, are riddled with life-altering errors that may mean the difference between you getting a job, a car, or a home at no fault of your own. So let's uncover the truth behind this 3-digit number. Let's talk about how you can use the current system to your advantage and how credit scores, as we know them, may go extinct in the near future.
What does credit mean to you?
Gosh, I don't know. Buy now and pay later, I guess.
Not bad. But there's a lot more to it than that. Almost everybody in the United States uses credit in one form or another.
How about giving me a little credit?
Nobody gives you credit, John. It's something you have to earn.
An FTC study showed that 1 in 5 customers have verifiable errors on their credit report, and 5% of people have errors so serious that they would be denied credit or need to pay more for credit due to that error that is at no fault of their own. But this hardly comes as a surprise because everywhere you turn are stories of issues with credit scores.
You know, errors on your credit report can cost you money, even cost you a job.
It could be causing you problems and you don't even know it.
As many as 40 million Americans have a mistake on their credit report. 20 million have significant mistakes.
Foy could not get a copy of his credit report due to an error on it.
4 million of us have mistakes that can lower our credit score.
10,000 consumer complaints about credit reports in the past 15 months.
Those mistakes can be nearly impossible to get removed from your record.
How is a 5% error rate, major error rate, acceptable by any standard? I mean, put it this way. This is a bit ridiculous, but would you find it acceptable if 5% of the time you sat down on the toilet and that toilet spontaneously exploded? It's ridiculous, but probably not. I know I would not be playing Russian toilet roulette with those kinds of odds. Now, do you find it acceptable that 5% of credit scores, a number that can determine where you live, where your kids go to school, and what job you get, have major issues? Probably not. It's a massive problem. So how are all of these mistakes happening? And looking into this, more than 50 years ago, Senator William Proxmire helped guide Congress through the Fair Credit Reporting Act. The goal was a fair, safe, and confidential system. 5 decades later, agencies have failed to make this a reality. In fact, during this time, Proxmire specifically stated errors in the credit system are a major problem. And an issue with credit reporting is mistaken identity, where one individual is mistaken for another and given a poor credit rating for the other individual. Sound familiar? Well, sorry, Senator. 50 years later, again, this is still the largest issue. Nothing changes. So how do they get it so wrong? A lot of it comes down to similar names or similar Social Security numbers, and you could see how that confusion could happen. Social Security numbers, though, they become a problem due to loose matching requirements. Data can be attributed to someone with as little as 7 out of 9 matching Social Security numbers. The whole thing doesn't even have to match. This leaves you open to potentially receiving data from hundreds, if not thousands, of other people who have potentially poor credit ratings. And then having the same name or a similar name to someone else causes even more issues.
Sandra Cortez, a California accountant whose credit report confused her with an international drug trafficker. David Smith, the retired Army officer whose credit report listed a bankruptcy that wasn't his and triggered a foreclosure proceeding against his house in South Carolina.
You think this would be very simple to get straightened out?
You would think. Yeah, you would think.
Sometimes credit agencies go as far as listing someone incorrectly as a domestic threat.
After being denied his dream apartment, he asked his landlord why. As an answer, the landlord forwarded his credit report. Can you read this for me? What does that say?
Terrorist.
Experian even has an article on their site about credit issues due to similar names. And in this article, they simply say it's a difficult problem to solve and individuals should simply dispute the information and get it fixed. A process that isn't always as easy as it sounds, even for something as simple as proving your own identity.
If you challenge a credit report, the dispute will likely be investigated in India or the Philippines or South America.
So all these people who take the time to meticulously document a case that the bill isn't theirs or the bill has been paid, that is never seen by anybody?
No, it is never forwarded on. Never forwarded on to the creditor. The dispute procedures used by the credit reporting agencies, uniformly used, completely fail to comply with the Fair Credit Reporting Act.
I think they're breaking the law. There is no doubt in my mind they are breaking the law.
In 2015, more than 30 state attorney generals wrote guidance for better credit reporting. However, again, customers are still facing the same issues and the same problems persist. And this is just the tip of the iceberg here. Credit influences most of the largest changes in your entire life. It affects your job, your home, your money, pretty much everything. 90% of landlords use credit reports when evaluating tenants. And it's especially important when home ownership is the largest asset in the average American's net worth. A survey of people living at extended stay hotels done by the University of Georgia showed that the largest reason for living in a hotel as a primary residence was poor credit. 58% of respondents had poor credit and couldn't find stable housing because of it, despite the fact that 84% of respondents had employment. They were actually working, but they still couldn't find housing. But even credit affects employment. Nearly 1/3 of all employers use credit scores as part of the hiring process. Credit agencies actually advertise the use and usefulness of using credit scores for hiring decisions. And they do this despite any evidence whatsoever that it's actually effective. Here's a representative of a credit agency testifying that it doesn't work.
At this point, we don't have any research to show any statistical correlation between what's in somebody's credit report and their job performance or their likelihood to commit fraud.
Believe it or not, your credit score can even affect your medical care. Some hospitals have begun running soft credit pulls on their patients, and this can happen before the question of financing is even brought up and before the hospital even knows what your bill might be. And patients report this happening without remembering ever giving permission to run their score. Typically what happens here is the patient will sign one of those electronic boxes and they're accepting a bunch of disclosures, and included in that is a credit check that they're simply not aware of. And of course, credit affects your car insurance, but I bet it affects it a whole lot more than you'd expect. Car insurance companies use credit scores to help determine rates, and this dramatically changes your insurance costs. This map shows where credit matters most in car insurance. Only 4 states prohibit the use of credit to determine insurance rates. However, in 38 states, car insurance on average costs $1,500 or more per year for those who have poor credit compared to those who have great credit. That comes out to 4% of the average person's annual income going towards increased car insurance expense, just because of credit score. It's actually more expensive to have bad credit than to get in a wreck. More expensive. All the problems with current credit scores come down to 2 major roots. 1, credit bureaus are for-profit companies without enough regulation. And 2, clients of credit bureaus are not individuals. Individuals are the product. You are the product. Businesses like banks and lenders, those are the customers of credit bureaus. The big 3 agencies, Experian, TransUnion, and Equifax, have a fiduciary duty to their shareholders to maximize profits. They don't have a duty to maximize credit scores. This leads them to expand their product lines to things like car insurance and tenant screening. It does not lead them to increase or help increase your credit score. Think about it from a lender's perspective, who again is the customer of the credit bureau. Let's say 5% of your potential customers may or may not have significant errors on their credit report. Would you rather give them the benefit of the doubt and risk them not paying their bills, or play it safe and overcharge them on interest? Of course, a lender is going to play it safe, especially when that means making more money. It all starts to make sense here once you zoom out like this and realize why nothing has changed in 50 years. All the same errors remain, and disputing claims is as hard, if not harder, than ever. There's actually a perverse incentive here where credit bureaus' customers benefit from mistakes being made on reports because they make more money on interest when credit scores are lower. And it's cheaper for a credit bureau to pay a fine because of an error than it is to change procedures. The only people who are hurt are the 10 million Americans stuck with wrongfully low scores and a difficult dispute process. Now, before we talk about how credit scores may completely change in the future, let's first discuss how you can actually use the current credit system to your advantage. Because the system's not perfect, there's actually loopholes here that you can use. So in my deep research on this topic, I've come across several tactics that don't get talked about enough. These tactics allow you to boost your score dramatically and for free. To set this up, let's look at the various factors that go into calculating your FICO score. From least important to most, we can see 10% of your score is new credit. 10% is for the types of credit that you use. So for example, a mortgage matters more than your Buckle Mall credit card. 15% is determined by the length of your credit history. So the questions here are, how long have you been using credit? And what is the average length of each of your forms of credit? 30% is your amount owed. This is the total you owed compared to how much credit you have. This is also known as your utilization. This one makes a big difference. And then finally, we have payment history, making up 35% of your score. Now, depending on your individual situation, tactics can vary slightly here with one exception. You must pay your bills on time. If you're missing payments, your score will stay low. There's no way to both miss payments and dramatically increase your score at the same time. So no matter your score, pay off your debts and your credit cards on time. If you're able to pay your bills on time, you're able to increase your credit score in a massive way. So tactic 1. The easiest solution here is becoming an authorized user. This can actually boost your score by 100 points or more in just a few months. However, this is only going to work for some people, so if it doesn't apply to you, don't worry, there's going to be other solutions. This is just the easiest one, if it's available to you. So to increase your credit score this way, you need to become an authorized user on the credit card of someone else's account that already has high credit. So if you have a parent or a spouse that has great credit and they trust you, you can become an authorized user, and within a couple of months, your credit score will take off upwards like a rocket. The bank's basically like, oh, you know Susie with the 800 credit score? You should have told us. Come on, get in here. We'll give you a good score too. It's honestly that simple. And this is what I mean about using the credit system to your advantage. This works if you have low credit or no credit. And yes, it seems too good to be true, but it's real. Google it, look it up. There of course are risks though to whoever has the high credit score. You could mess up their accounts if you go on a wild spending spree and you can't afford to pay it back. So you have to be careful there. But I know this solution doesn't work for everyone, so let's move on to ways that everyone can take a score from 0 or low to a good level. This is tactic 2, the credit utilization hack. So step 1, get a credit card. If you have 0 or low credit, you simply might be denied for any credit card that you apply for. If this is the case, what you need to do is go to your bank, preferably a big bank with a lot of recognition, and get a secured credit card. Put a couple $100 on there, put whatever you can on that secured credit card. Then step 2, use your credit card or secured card for regular expenses. Don't overspend because we have to pay this back. Step 3, pay off your card completely except for $1 every month. Now you have to do this very specifically. Pay it off completely except for $1 right before the statement date. This is the date that billing ends. This is not the date that payment is actually due. Step 4, once your statement is actually due, pay that remaining $1 in full. This simple tactic reverse engineers the credit system and can bump up a score by well over 100 points in just a few months. And here's why it works. Credit utilization is 30% of your score. This is the percentage of your available credit that you use every month. So if you have a credit limit of $2,000 and you spend $1,000 every month, your utilization is 50%. To have the best results possible for your credit score, you want utilization under 10%, and really 1% is ideal. The reason this works is most major banks report your data to credit bureaus after the statement date. So your statement shows that you only spent $1. And having a balance of $1 means your utilization rate is going to be around 1%. So boom, 1% utilization, and that is 30% of your credit score now getting maximized. Due to obvious reasons, there's been a lot of talk of completely overhauling the credit industry or starting a federal credit option. There's a lot of desire for a fair credit system that does things like limit errors and has an innocent until proven guilty methodology, helps victims of predatory lending because consumers can fall into this trap of abusive lending, which can then jumpstart a cycle of having bad credit, but then needing credit to better your life, and not having money because you don't have credit, and then things just get worse and worse, spiraling out of control. They want a system that limits reporting of medical debts, a system that differentiates between debts as a result of a one-time hardship and debts due to negligence. The whole thing isn't about doing away with negligence. If you're negligent and your credit report reflects that, that's fine. That's what a credit report is for, but we don't want to hurt people who shouldn't be hurt by this system. We want a system that limits the use of credit scores when they're found not to be useful. We want a system that knows whether you're alive or not.
Helen McGill was shocked when she went to buy a travel trailer to learn she was dead.
The financial manager came out and said, "Do you have like a copy of your card, because you keep coming up deceased?" So I was like, there's no way. I even paid at that point too to get my credit score. You can't get anything when you're deceased. No credit score, there's nothing. You don't even exist.
The most dramatic way to make this happen would be by adopting a proposal that has gained a lot of steam recently. That's building a publicly run credit reporting agency operated free from profit incentives. The belief is that a publicly run credit institution would have the following qualities: greater equity and reliability in predicting creditworthiness and limit racial disparities, more transparency with publicly available explanations on how your score is calculated, higher accuracy in data by making companies who furnish the data liable for incorrect information. That'd be nice. More accountability by giving customers the right to sue if the credit registry fails. Using credit for lending purposes only, and greater security when individuals already trust the government with their data, like the IRS, especially after the Equifax breach. Now, historically, the US government hasn't been the greatest at facilitating new, bold technology. But it's possible. I mean, I see the benefits in this ideal system if it was built properly and administered properly, but I see what the critics say as well. They say that this would be expensive. They say that the odds of the system actually being better are fairly low. And you have tens of thousands of employees at the big three credit agencies that would just be out of work due to dissolving the big three. This is a massive $14.4 billion industry we're talking about. So I have an alternative solution. I believe this would solve all the same issues for less expense and fewer disruption of current jobs. Keep the big three. Keep the big three and create a comprehensive credit act. In this act, put the liability both on credit agencies and those furnishing data to provide accurate data. Then provide a fast-track method for recourse if your credit data is incorrect in any way. $1,000 per instance should get the credit agency to figure out their problems pretty quickly. Then increase the damages repaid to individuals due to incorrect credit reports by tenfold. That way it's no longer considered regular business expense to just pay a fine and change nothing for 50 years. Have external auditors regularly test dispute functionality, ensure that decision makers are actually reviewing disputes, and disallow the use of credit in decisions like employment where there's no clear causal link. And there you have it, credit is fixed.